Hey everyone, today is June 9th, 2020. Right now it's 10:25 p.m. Eastern Time. The market has closed. So let's take a look at market today. So I drew this a couple of days ago. I was expecting the market to continue to go up, and right now we are almost more than 3,100. My target was 3,100. I obviously have broken through that, and now we are at 3,200. 24.50 on the index, and we are actually up year to date, which is really amazing. So the market has completely fully recovered from the beginning of this year, and it has been a crazy wild swing, and this was a huge money making opportunity in such a short period of time. And so the market today just continued to go up. I don't expect this to correct anytime soon. So I think that we're probably going to reach this major trend line here that I drew to the 3,300 level, even to 33.38. That would be the next target. However, I'm not in the market right now. So if you are, I'm not in the market trading. I still have my retirement account in the market. But if you are in the market, holding your long positions, just keep holding. Do not short. Right now is a bad time to short. Right now is a bad time to buy the VIX. I know some of you retail traders are buying the VIX, the TVIX or the UVXY, all that VIX products. The decay here is crazy, because if you go to VIX Central, you can see that the VIX Central here, the VIX is already in contango, okay? And actually, what's interesting that the VIX in the December month and January February month is actually in backwardation. So this is actually a very interesting VIX term structure that I've noticed in recent years. Is that usually the VIX term structure is a curve like this. It's a curve that like this. Like a hockey stick, but that's just laying on the floor like that, right? And you see that the VIX structure now is like this, up and down, up and down. So let me just reset this. This is a very interesting VIX term structure. If you've been trading VIX for a while, it seems that the market is expecting the volatility to rise again in October, November-ish. That's why the market is assigning kind of low VIX to November, December, January, February-ish in backwardation. That's really, really interesting. That is really interesting. Okay, so let's take a look. And let me see. Regarding the cryptocurrency, Bitcoin, Ethereum, they are just not doing anything right now. I expect this thing to consolidate and probably correct downwards. The longer we consolidate this area, the actually higher chance we break down, because just because the cryptocurrency participants are kind of different from the stock market, because they are. It tends to go down and do the wash and rinse more than going up, because the cryptocurrency market is very long biased, and at the higher level, a lot of participants, they hold options positions and future positions that has leverage. So usually what happens is what the whale does is that when they go fishing, they kind of bait you by making the low volatility and making sure the price goes up a little bit gradually, and so they're just baiting you to open up your long position. So anyone opening up their long positions, or especially future positions, with a very low volatility, they would be kind of tricked into buying their future position with a very high leverage, right? Because the market is very very calm. So these people, they just keep adding to the future position, and it's very likely for a lot of inexperienced traders, they kind of over leverage themselves in this market, because what happens is if the volatility is very high, what happens is a lot of people are just gonna be kind of be scared, and when they start adding to the position gradually, they are more restricted because they could be just washed out, right? When the volatility is very high. But now the volatility is very low, so for a lot of the traders who got into the market who are inexperienced, they're adding their long positions, especially in Bitcoin futures, Ethereum futures, or leverage positions in their margin account. On these, they are basically it's very easy for someone to buy more than they should have based on their account size. So a low volatility market is basically accumulating these risky weak hands, and so these guys are buying, and one day the market just drops and do a rug pull, just like this, right? Look at this part, and also look at this part. Very low volatility moves at the before a major drop. Very low volatility move before a major drop. Very low volatilities and gradually going up before a major drop. So now we have a pretty low volatility move, and maybe we're gonna have a bigger correction to this level. I don't think it's gonna correct that much to this lower level. I don't think so. I think we're probably gonna correct to this level. Maybe we're gonna consolidate at this particular range for Bitcoin. It's very difficult to say. Okay, so today the video I want to talk about is this person who made a comment in my last video. If you haven't seen it, I talk about the similarity between the patterns in Bitcoin versus the Amazon. And so this person, he talked about that I'm comparing, roughly 4-year price movement BTC with 10-year Amazon. I can find the same pattern in 5-minute chart. It doesn't mean anything. So, of course, you can find some pattern in your 5-minute chart. But my response is that when an asset that are completely unrelated, that have extremely different fundamentals, obviously, different asset classes, different fundamentals, yet their price pattern, if the market is efficient, if they are indeed different asset class and extremely different fundamentals, then their price moves, logically speaking, they should be different, right? If you think about it, he just said if these two asset classes with extremely different fundamentals, and logically speaking, they shouldn't even have a similar pattern. What's the chance of having two asset classes with extremely different fundamentals to have the same pattern over a course of 4 years or 2 years? I'm not talking about minutes, right? Minutes, on the minutes level, on the daily level. I mean, just by sheer random chance, you could have these patterns to be the same. But over a year, 2 years of price action. So let me just move to that section of the video so you can see what I was talking about. I was comparing the Amazon chart versus Bitcoin. I basically overlaid the Amazon chart on top of it. You can see the similarity is absolutely striking. And if you think about if the market is efficient, two asset class in complete different time period, to complete different economy, with completely different fundamental. Obviously, the one is a cryptocurrency, it trades like commodity. The other one is a stock with a real company behind it. But yet their price. So what's the chance of having their price action logically to be identical over the course of a few years? Statistically speaking, if you think about it, statistically speaking, the chance should be zero. The chance should be zero. So this guy, he brought up that this is a Apophinia effect. Apophinia effect. So what's the Apophinia effect? Apophinia effect is basically a tendency for someone to see patterns in random or unrelated data, right? In unrelated objects, and one of the very classic example, just to seeing patterns in the cloud. For example, this one looks like an angel, or a goat. It could be. This one is a horse, obviously. So you're seeing patterns. This one could be some lion face, a tiger face, or something, right? So you are seeing patterns and obviously a random objects in the cloud. Just how human mind works. But however, in the stock market, when you see some pattern in a particular if they are related, they're doing the same pattern, it's actually less significant than having a bunch of asset classes over the course of a few years to have almost the same pattern. Because that is not, statistically speaking, that cannot be a coincidence. The chance of a stock that's or two asset classes completely unrelated in a completely different time period to have this almost identical pattern is not the chance of, statistically speaking, for the coincidence is almost zero. The reason that they have same pattern, if you do logical deduction, it means that the underlying property of these two asset classes could be identical, could be similar. So what is the underlying property? The underlying property is human nature. So the human nature stays the same throughout the course of history. That is a fact in the stock market, and you're going to see that over and over. So one of the very, very interesting documentary I really recommend you guys to watch is Paul Tudor Jones. The documentary is called Traders, and Paul Tudor Jones. This documentary was filmed in 1987, right before the 1987 crash, and Paul Tudor Jones was able to predict the 1987 crash by comparing the chart of 1987 to what happened 50 years ago, 1929. So let me just show this video.
Yet the market won't break. It is screaming to me that it wants to go higher.
At times like this, what gives these two confidence is a theory that says the stock market moves in cycles, in patterns. And Paul and Peter subscribe to the Elliott wave theory, which says to them that what happened 49 years ago, in the late 1920s, is happening again, now.
If the market is a reflection of people's behavior and people behave similarly in similar circumstances, then history of market prices may give us an indication of what may happen in the near future. Well, the last great bull market really was the 1920s. And we looked back and did a statistical analysis on the 1920s through today, punching in literally thousands of Dow high, low, and closes to run correlations between what happened in 1925 to 1928 to what happened between 1982 and where we were in 1986. Well, that correlation turned out to be over 90%. In fact, since I've run that correlation, the correlation has gone up from about 90.7% to close to 92.2%. And as you can see,
which one is the 20s?
The 20s is the blue, and the red is the 80s.
So what day back in the 20s are we at right now, approximately?
We're like in early August 1928.
And so let's see, if my memory serves me correctly, and we've got another 40% in the down the upside.
Correct.
So we were talking about...
And about another year, a little over a year, up moving the Dow.
And then it looks like there might be some storm clouds in the horizon.
To say the least.
The correlations here are phenomenal. That's incredible. What are the chances of taking any 5-year period in the stock market and getting that kind of correlation? What would you guesstimate off the top of your head?
I mean, it's got to be astronomical. You're talking 1,000 observations. I don't know, 1 in 1,000. It's really pretty scary. You know, if it looks like a duck and it acts like a duck and it sounds like a duck, it's probably not a chicken. And that's what's scaring me about the activity in the stock market right now.
Some analysts disagree, but Paul Jones and Peter Burish are among those who think there's a crash coming, and a big one.
Okay, long story short, what happened after that, the Powell Tudor Jones was able to successfully trade through the 1987 stock market crash. He was able to capture that completely. He made almost, I think he made $100 million in that trade. $100 million in 1987. That's equivalent to, you know, probably $1 billion in today's money. And yeah, so that was the this thing in action, right? So Apophinia effect is everywhere in the minute level time frame, in the minute level daily time frame. But when you compare, when something in the market that is almost identical, that happens through, you know, a month of data, that's something we absolutely need to take very seriously. We cannot simply ignore it. I'm not saying that we should follow the pattern very blindly, but we should definitely take that into account, take the possibility of this underlying human nature into account, to really be aware of the potential outcome from these kind of patterns. Of course, we have to take account into other external factors, such as the Federal Reserve, such as, you know, the virus, such as, you know, the macroeconomic factors. When you have an external shock, as I talked about in my last video, the pattern actually diverged because we had an external shock with the coronavirus, where the liquidity dried up in the market. So the fall here was much more severe compared to the Amazon pattern in 2000. So we need to take account of all these factors when investing in any of the asset classes, and these patterns, some of these patterns, I'm not talking about, you know, day trading. I'm not talking about swing trading. I'm talking about long-term years of similar patterns. That should be taken very, very seriously, according to my more than a decade of trading experience. Okay, so you know, I've been very bullish on the market, so I'm going to review another one of my analysis that I've done, you know, 3 months ago. I've been very bullish on the market. The reason is, let me show you something. So this thing can only be seen in the E-mini 500. So when the market came down here, when we made this this bounce, a V-shaped bounce, and we had this two kind of we came up again, we had this kind of M-shaped pattern, and then we consolidated a little bit, and we broke the trend line. I was absolutely bullish at this point. The reason is I look at, you know, hundreds of years of data, and the Dow in 1966 had a similar kind of a correction where, let me just remove these so you can see this very clearly, why I have been very bullish since April 3rd. So you can see that we had a trend line, a very simple trend line here. We just put a trend line here in the 1966, and you can see that here we came kind of touching the trend line. We came here touching the trend line, and we have this kind of you know, M-shaped pattern here at here. So I was looking at this, and I was just betting on this could be a potential, just like 1967, this could be a potential interim bottom. And again, you could say that in 1967, the market has a very different fundamental, very different economy, you know, completely different market participant. I wasn't even born in 1967, but yet the human behavior, despite all that technology, despite all that algorithm in the world, algorithmic trading, all that stuff, you can see that the human nature is still very similar. And we could just, I basically just use this, and I was just going along here, and I basically went along all the way until this point. Then I sold through my trading account, but my retirement account I'm still holding out for the long term, of course. But my trading account actually sold too early because I sold it here. I saw the market going fall, but it seems that it was just a shakeout, and I got shaking out. I mean, I didn't get shaking out because I didn't take my loss. I took my profit here, but I did not re-enter. I should have re-entered. But hindsight is 2020, right? It's very difficult to predict the market's every move. But just by capturing this, I was going, all in, completely bullish in the market because this behavior. It's very straightforward, really. If you look at this, it has happened before. If you know the history, you will become aware of this behavior in the market. It's not Apophinia effect, because this happens over course of many trading weeks. It's not an intraday, it's not random data, right? This happened in several months. This happened in several months. It's not a random data. Okay, you have to identify what's random. Like if you look at, if you zoom in and look at daily stuff, you're gonna see patterns everywhere, buddy, and that's just complete, just waste of time. Okay, you look at head shoulders, that's a waste of time, complete waste of time. But stuff like this is something we have to take account of. We have to focus on. So the art of trading, the art of investing is able to recognize something that's not noise as an investor and being able to act on that information. At the same time, filter out a lot of noise in the world, because there's just so much information going around in the news, in the media. You can get all sorts of derivatives, you can get all sorts of data, the holdings, all that crazy stuff. But at the end of the day, you really have to be able to filter out all the useless information and really focus on what the market is really doing. And that requires a lot of experience, and also requires a clear head to really disconnect you from the mass media, what the mass media is telling you. Like right here, right? We had some sort of a job report coming up. I remember that, and I was just ignoring the job report. I know the job report is bad. I know that's probably priced in, and it turns out it was like a rally when the job number when the unemployment data came out. The market actually rallied very hard. I just remember that, and that just it doesn't matter. Like even if the job number doesn't even come up, I think the market's going to rally anyway. And you can see that here, the market just rallies anyway. So the news follows the price, and people are trying to use price to explain the news, but sometimes it's just human nature in work. You don't have to. The price movement is not triggered by the news. It's gotta go. It's gonna go. When the big money start buying here and start consolidate, there's the basics, the supply demand is already being kind of tilted to the bullish side, right? Like at this point, loss of volume, huge amount of volume was buying the stock market at this point. So the supply demand is tilted to the demand side. So this consolidation happened, and the market just took off. It's just very simple. Okay, that's how the market mechanism works. I just want to talk about these interesting stuff I found, and hope you guys enjoyed this video, and see you next time.